Welcome back to my channel, Victory Reverse Mortgage. I'm Benny Victory. Today is December 1st, 2022. For the month of December, I wanted to put out a personal challenge for myself and make one video a day discussing the relevant and important topics of reverse mortgages. These educational videos, I primarily share them with my clients and their financial advisors, but I feel it's important to have them available for the general public, especially for some of the seniors that are looking at getting this information and don't have access to it or getting false information. Today's video is going to be a two-part video that I'm going to do today and tomorrow, and it has to do with some of the linkage that people associate with reverse mortgages and foreclosures. And that has to do with the past history that I've discussed in my other videos about how some clients were given all of the money at once, and when they were given all of this money at once, they didn't account for paying their property taxes, and that became a problem. So we as an industry have resolved that issue, and that's not a consideration anymore. There's an extensive financial analysis that's done when we do an underwriting on a file. And even though credit is not typically a consideration, it's a factor that we look at as a determination to see the client's ability and willingness to be able to pay their ongoing obligations, which is predominantly taxes and insurance. In this video, what I wanted to do is to dive down and set the foundation for what the causes of foreclosure are, and to do a compare and contrast between the traditional mortgage or a forward mortgage and a reverse mortgage that I am obviously a big fan of, because having done both the forward mortgages and now exclusively the reverse mortgage, there's not any doubts in my mind that for seniors going into their retirement on a fixed income, the benefits that a reverse mortgage can give is significant. Today's video is going to be predominantly talking about the framework that we're going to establish so that tomorrow when we do the numbers, what I'm saying today becomes bright, evident, without any questions. Now, for the purposes of this video, I didn't want to put in any figures on the conversation that we're going to have, because I didn't want it to be that there's going to be some consideration of bias that I'm stacking the deck in the favor of the reverse mortgage. So if you're a senior, if you are someone who's considering getting the reverse mortgage, this would be the conversation you and I would have in person. And this is an opportunity for you to do the homework and to participate in your retirement and to see the benefit as I see it, as it relates and is relevant to your particular situation. So I would really encourage you to kind of go along, take a piece of paper and a pen, and write down the figures as they relate to you. Because it doesn't matter what I think, it only matters what it means in your life. And if you see it the way I see it, both today and tomorrow, then you're one giant step closer to seeing how this could be a good tool to help you with your retirement. So for today's analysis and conversation, I broke out the blackboard. I think it'll help to be a little bit easier to see. Hopefully my writing is legible enough for you guys, but I'll go over it. And I sprang for this nice little pointer to help us. So the title of the video is going to be Foreclosure Risks, Comparison, and Analysis. And that's exactly what it is. We have to discuss the foundation of what causes a foreclosure risk. Well, the first and foremost is not going to come as a surprise to anybody, has to do with the non-payment of your monthly mortgage payment or your home equity line of credit payment. And for some clients, they have one or the other, and for some clients, they have both. So obviously, the lender, your bank, is expecting to receive monthly payments for either your monthly mortgage payment or your HELOC. No mystery there. And your failure to make timely payments is, God forbid, the first step towards foreclosure. The biggest cause is property taxes. And like I said, for reverse mortgages, that used to be the case, but not the case anymore. And property taxes are collected by the county or the state. So when I hear people tell me, oh, that, it's because of the lender. Well, property taxes are paid to the county and the state. And if you have an impound account, the lender has the ability to collect that monthly payment and then forward it to the state. I liken this to when you go to the car dealership to buy a car, and the car dealership, whether you're buying a used car or a new car, collects the taxes and sends the money to the DMV on behalf of you. It's the same idea. Your property taxes are collected from the county or the state, and if you have impounds, by the lender. But when you don't pay the property taxes, in order to avoid the county or the state foreclosing, then the lender is forced to pay on your behalf. And at some point, if they can't get reimbursed, obviously they're going to go after the property and collect it. The next one, which surprisingly is even more aggressive than any of these other ones above, are for people that have homeowner associations. Whether you live in a planned community or a condominium, the homeowners association can be very aggressive, where if you fall behind on your homeowners association, even if you're okay with your monthly mortgage payments or on your property taxes, the homeowners association will go after you and move towards foreclosure to get reimbursed. And the last one, which typically is not happening, but I wanted to put it up because I wanted to have an inclusive list, has to do with home maintenance. And if you think about it, it makes absolute sense, because your home is the collateral that the lender is lending on. So if the roof is falling in, if the pool's cracked and the water is seeping all over the place, if there's damage to the house, the value of the house, the collateral is going to be concerning to the lender, and they're going to foreclose because they're going to have to get possession of the property. So once we understand the framework of what the causes are, we want to get into the comparison between a regular mortgage, which is a forward mortgage, which is what you had and what I've generated for the past 18 years, and the reverse mortgage and what I do now exclusively. And the reason I said at the beginning of the video to get your own particular information in here, because whatever I put in is not going to be relevant to you, and only your numbers are going to be the case in point that you need to make a decision, and an educated decision after today's video and tomorrow, to see the argument that I'm going to make on behalf of the reverse mortgage, that if you're worried about and you associate foreclosures with reverse mortgage, it's really far from that. If there's any reason for foreclosure, it's more likely to happen with a traditional mortgage. And to give away the ending, that it's obvious, because its monthly carrying cost every month is significantly more. But I'll break that down for you. So with the regular mortgage, you're going to look at what your monthly payment is on your mortgage amount, and if you have a home equity line of credit. It's either one or the other, or both. So that's the first and most obvious thing. Not so obvious is how many years is left on your mortgage or on your line of credit. First, the mortgage itself. If it turns out that you have 8 years left before you pay off your property, and let's say you're 70 years old right now, that means that not until age 78 are you going to have the house paid for free and clear. But it doesn't end there. There's also a consideration that you have to figure out, that in the 8 years that you still have left, there's going to be a remaining total interest that you're going to have to pay. Because obviously, if you get a 30-year mortgage and you've refinanced it, then it's extended out. And if you didn't, and you're paying off the entire 30 years, and you never refinance it, what you can do is you can use a mortgage calculator to calculate the total amount of interest that is owed on the mortgage. And in another video that I did, which I would definitely encourage you to see, because it gives you the overall picture of a lot of pieces. And In that video, I gave the example that if you borrowed $300,000 on a 30-year fix and you never refinanced it, if you looked at the total amount of interest, you would have paid $200,000 in addition and on top of paying off the $300,000. And that's the total interest that we're talking about. Now, the reason I'm suggesting that you find out what the total interest is not to make you feel bad, but to impress upon you two factors. Number one, the years that you have left and the amount of interest that you're going to have, or if you decide to write a check for $100,000 tomorrow and pay off your balance, they're going to have a significant impact. And what is that impact? Well, the impact is that you're going to have to use your savings or investment to pay off the house. So when you write a check, whether now or 8 years from now, and you've paid off the house, that came at a cost of you using a significant amount of your savings or your investments. And that savings and investments is now a big chunk of money that now you don't have available to help you last out your retirement. And that's where the concern for longevity comes in, which is people are terrified of running out of money before they run out of life, which obviously is a significant consideration. So in this section, we're just primarily talking about how much do you owe every month, and what is it going to cost for you to keep this and run it till the end, or to write a check and pay it off. The next two are very obvious. It's your property taxes divided by 12 months. You get a monthly figure. It's your homeowner's insurance divided by 12 months, and you get a figure. And this becomes your total amount. That becomes your mortgage, your home equity, your taxes, and your insurance. And for some people that we talked about, if they have a homeowners association, I put a little separate asterisk on the side here so you could calculate your homeowner's insurance, and now you have a total here. But this total is just for your housing. It doesn't include what I call soft costs. And these soft monthly costs are other obligations that you have to have every month. And you can't disregard them and say, I'm going to pretend they don't exist and I don't pay them. Well, if you do, you're going to be sitting in the dark and without water. So other soft costs are your DWP bill, your water and power. How much is that every month? Average it out. Your gas, how much is that? If you have a single family residence, or you're obligated to pay for your gardening and your ongoing pool service, and they're not covered in a community or homeowners association. These soft costs are another figure that you end up adding to this amount. And that becomes your total amount of housing, the total overall picture. Now, when we look at a reverse mortgage and we do a comparison, what do we see immediately? Well, right off the bat, guess what? You don't have a monthly mortgage payment anymore. And if you had a home equity line of credit, you don't have that payment either. So whatever that amount is, you could just put a line through it and say, if it was $1,800, I don't have to pay that $1,800. Immediately, that opens up an opportunity for you to redirect that $1,800 or whatever that amount is to pay for what? To pay for property taxes, your insurance, and go towards your soft monthly costs. Now, another opportunity that you have here with a reverse mortgage that's not a conversation in your regular traditional mortgage is the fact that you may have a line of credit with the reverse mortgage. If there's enough equity, or if we could put you in a situation where you don't have an existing mortgage at all and you want to get a reverse mortgage as your primary mortgage. So this line of credit, in other videos I've gone into detail, but just to touch base on it, is significantly different right off the bat for what? Well, obviously, you don't have a 10-year interest-only period, so you could pay anytime at any amount that you want. You don't have a 15-year period where you have to pay principal and interest to pay off the home equity line of credit in 15 years, which is what you do have up here. You never have to worry about it to be reduced or closed or frozen by the bank because of their home values going down and the bank being worried about you being able to make it. But the biggest difference that I want to point to is that on the reverse mortgage compared to the traditional mortgage, and the reason I asked you to find out what this figure is, how many years left and how much money it's going to cost you before you pay off the entire amount, is that if you find out that, let's say you have to pay $150,000, $200,000 before your mortgage is paid off, before your house is free and clear, and whether you write a check for that tomorrow or it takes another 5 to 6 or 8, 10 years, you're doing that so that you have housing security, so that you and your spouse can stay in that house for as long as you want without having to make a monthly mortgage payment. Well, the reality is you can have that security for you and your spouse as soon as you get a reverse mortgage. You don't have to wait, and you don't have to deplete a significant amount of your savings or tap into your investments to have the housing security of being able to stay in that house for the rest of your life. Because right off the bat, when we do a mortgage for you, we pay off the existing balance, whether it's a home equity line of credit or your existing mortgage. And by doing that, and you not having to make a monthly payment, guess what? That savings that you would have used over here is able to help you stretch out your total retirement. And that gives you tremendous amount of flexibility. And this opportunity here not only gives you more cash flow, but it gives you more freedom and it gives you more versatility. And for the purposes of the conversation that we're having today, I just wanted to lay the foundation of the triggering events for and possibilities of a foreclosure, and to set it up so that you could see the difference between a traditional mortgage and a reverse mortgage, and to see that if anybody was going to be at a danger, the danger zone, quite honestly, is with the traditional mortgage, because when you look at your monthly total here, that is going to be significantly more than what this amount is, simply because of the fact that there's no mortgage. Tomorrow, we're going to do a more individual conversation around you and your spouse and your income sources. And if we take in that income into consideration and we put that over this framework, what is going to happen and why is it a danger zone? So to finish up, like I mentioned, the next 30 days is a personal challenge for me to do a video a day. If you found this video helpful, if you think this is something that you hadn't considered before and it's something that you can share with somebody else who's considering a reverse mortgage and benefiting it from it, I would ask you to share it with them. If you found the information useful that you can come back to and get more of this type of information, either subscribe or like the video. It's not about my popularity or my desire to do anything other than to share this with the community of people who need it. Seniors right now are having a very difficult time. They're on a fixed income and the challenges are abundant. And anything that can be done to put them in a position where they have a little bit of financial dignity and financial independence is an opportunity that I want to share as much as with them as possible. So I look forward to seeing you the next 30 days, God willing. I thank you for your time. I appreciate you being my client. I was going to say my patient. And I hope that this information was helpful to you and you could put it to good use. Thank you very much and see you on the next video. God bless you. Bye-bye.